Shifting focus then, let's get into a conversation to understand the underlying fundamentals of the market, what looks good right now amid all the news flow that you're getting, how to make sense of all of that. We have Mr. Ajay Tyagi, Head of Equities at UTI AMC, joining us on the show. Mr. Tyagi, hi, good morning, and thank you for your time. First of all, help us understand how you are seeing the market right now. Over this entire week, barring today, we are seeing some shade of green, but the markets have largely been under pressure. The FII selling has continued, but so has the DII buying in the exact quantum that we were seeing last year. The support domestically looks good. What is your take on where the markets are headed from here?
Sure. So, difficult to forecast where the markets would be in the next few months. That's certainly not our endeavor. But just to put things into perspective, I just wish to remind you and the viewers that, valuations for the Indian markets have been at a premium to long-term averages. And this is something that has been happening since 2024. Of course, the markets made, a peak in sometime in August 2024. And from those levels, markets have been consolidating now for about a year and a half. However, it's also a fact that the last couple of years, earnings growth has been fairly anemic. While we look at a trend growth of around 12%, very close to our nominal GDP growth, but earnings growth both in 2025, that is FY25 and FY26, has been below trend, somewhere around 6 to 7%. Therefore, markets which were building in stronger than trend earnings growth have been disappointed to have actually witnessed poorer than trend growth. And that's one reason why we've been consolidating. We still, despite this consolidation, are trading at approximately 15 to 20% premium to our long-term averages when it comes to large caps. When it comes to mid and small caps, that premium is even higher. So, our forecast is that markets could remain range bound for some more time, maybe, about a year or so. But relatively speaking, our comfort is more in large caps. Yeah.
Right. Ajay, you've also suggested somewhere that, and you hinted towards it even now, that valuations look slightly elevated, if I can call it that. But we will very, very quickly start discounting earnings for FY26 fully. That's likely fully digested. But even for FY27, because you'll start seeing 1 year forward earnings starting to get rolled through. And there are plenty of measures which are taken on the domestic front. Plus, we have the budget as well. An acceleration or a positive upside to that earnings is more likely than a downside risk, in your opinion?
Yeah, that's a good question. So certainly we are looking at acceleration in earnings in FY27. As you alluded to, there have been quite a few measures which have been taken to, at least push consumption and consumption-related sectors in the country. So we did see the benefits given during the budget last year in terms of income tax benefits to households. We also saw rationalization of GST. So therefore, there's a huge amount of savings that households are going to witness by way of GST rates coming down. Put together, this number is somewhere in the ballpark of around $35 billion. Not a small number, for the economy at an aggregate level. However, I must also mention that the estimates for FY27, and once again, like you rightly said, all estimates have to be now built on FY27. So FY27 consensus estimates are already at about 16% earnings growth over FY26. So to some extent, all of these positive measures and their consequences on growth translating into better earnings for corporate India is something that is being built in already. And despite that, valuations are what I just suggested. So, once again, let me break it up into two parts. Do we see better growth from corporate India? Hopefully, yes. Does the market start moving up substantially on back of those numbers? Perhaps no, because, basis these numbers which are already discounted, markets are still expensive. Yeah.
Okay. And Mr. Tyagi, talk to us about where do you think valuations have slightly corrected, even though they continue to be higher on a consensus, given the way the markets have been range bound and slightly under pressure recently. Where do you think valuations are now looking slightly more attractive, and which sectors do you think could do well on the back of fundamentals and also valuations?
Sure. Our opinion is that private sector banks in general haven't really participated in the rally over the last few years, and we still feel, I'm sorry, that private sector banks on an aggregate will continue to gain market share in the coming decade as well. Their underwriting skills are much better than their PSU counterparts, and by the way, valuations here, contrary to the entire market, are trading at a discount to their long-term averages. So this is one area where our comfort is high. We also feel that the central bank is pushing for credit growth in the economy, and therefore, at an aggregate level, credit growth should be better in FY27 compared to the previous 2 years. That should also lead to better, advances growth and NII growth for the private sector banks as well. So that's one sector where we remain positive. The other sector which actually has faced the heat and has been pummeled over the last 2 3 years is the IT sector, and there have been various reasons for the IT sector not to do well. Once again, here we feel that the AI disruption is overblown. In fact, while there may, be some amount of deflation in budgets because of AI, but on an aggregate, as we have seen in the previous IT cycles, whenever a new technology comes in, Indian IT companies, end up gaining over the medium term. So again, in the IT sector, valuations are just about close to their long-term averages. They certainly aren't at a big premium to long, hence the comfort here. Auto sector is the third one. I think in the previous question we were discussing about a possible push towards discretionary spending, both in terms of savings on income tax. We also talked about rationalization of GST. The auto sector in general has seen a big benefit on account of GST rates coming down. So the auto sector should also benefit. Valuations here once again are very close to long-term averages, hence the comfort here. So I would say, yeah, these are the three sectors where we would be looking at more actively in terms of picking our bets. Yeah.
Okay, Ajay, if I can ask you from an auto sector standpoint, what within the auto space looks best placed? Because there's again plenty of traction with regard to demand on all fronts, two-wheelers, PV, CV, but the CV cycle has picked up as well. So plenty of moving parts. What within auto are you liking the most? How best do you play it?
So I'm afraid I can't be very specific, but I'll just try to
Understanding that, yes.
I'll give a general answer. So
Sure.
I think if I could break up OEMs versus ancillaries, I would say we are more bullish on OEMs than ancillaries. For the simple reason, if you look at the outcomes over the last 3, 5, and 10 years, the OEs have given better outcomes compared to ancillaries, and yet they are trading at multiples on an average significantly lower than auto ancillaries. And to an extent, this is inexplicable. I mean, we can't understand the reason why, despite better outcomes, better balance sheets, much better return on capital outcomes and growth, they should trade at a discount. So clearly, our predilection within the auto sector towards auto OEs. That's point number one. Uh, within auto OEs, our view is that the one segment which will continue to see structural growth rather than cyclical ebbs and flows would be the passenger car segment, which obviously includes UVs as well. So let's call it four-wheelers. The four-wheeler segment is the one which would witness structural growth on account of the under-penetration that we have in the country. And obviously, as per capita income grows and purchasing power grows, more and more households will be able to afford, four-wheelers or passenger cars. So
Sure.
that's a broad thesis. Yeah.
Okay. Mr. Tyagi, on that note, I'm afraid we'll have to let you go. We're facing a little bit of a time crunch today, but thanks so much for your views.